Hi, welcome once again. This is Khurshid Alam from BDO, Mongolia, and I am very grateful for Mona CPA inviting me here to give you presentation regarding climate change. So let us discuss how this climate change affects. Why does climate change reporting matters to the auditor? The answer is that for many entities that affect climate change have a significant role to play in the short term, medium and long term. The global initiatives that are underway to address the urgent need for climate action will affect government policies, investor decision making and many stakeholders. Governments worldwide have made numerous commitments to mitigate the effect of climate change. These include the Paris Climate Accord and further commitment made at COP26 in Scotland in November 2021 and at COP27 in November 2022. Government commitment will require changes in policy, laws and regulation. These will affect many entities. An example is the new legislation in the European Union. Investors and lenders are also demanding greater transparency in how an entity contributes to climate changes, such as its emission and carbon footprint, as well as how these effects of climate changes may create risk or opportunity for a business. The regulatory environment is also changing, with a range of jurisdictions looking ahead to the likely adoption of ISSB sustainability disclosure standard, as well as other developments such as the proposed climate disclosure rule in the US. However, for our presentation, we will restrict only to the climate changes part affecting the financial statement. So now a brief reminder about IFRS foundation material that affects the accounting implication of climate change under existing IFRS accounting standards. The first of these is an article that was published by Nick Anderson, an ISB board member, in November 2019. This was followed up a year later by ISB staff education material for the effect of climate-related matters on financial statements, which explains how current IFRS may require climate-related matters to be considered in the preparation of financial statements. In each of these publications, although it is not noted that IFRS accounting standards do not explicitly refer to climate-related matters, but many requirements in existing standards may indirectly require their consideration. Both of these matters has been summarized in BDO IFRB 2014. Now let us see what is the educational material which was issued by the IFRS Foundation. So as we see that ISB issued this educational material in November 2020, and they have given some few examples, although it is not an exhaustive list, which affect the accounting standard. These are IS1, presentation of financial statement, IS2, inventories, IS12, income tax, IS16, PPE, 38, intangible assets, IS37, provisions, IFRS 7 and 9, financial instruments, IFRS 13, fair value, and IFRS 17, insurance. However, this is not the exhaustive list. Other standards could also be affected. A starting point is to consider whether climate is a material issue for an entity. It is noted that in the staff education material that the materiality practice statement may be useful in making that judgment, and that it is necessary to consider the effect of climate-related matters on financial statement when the effects are material in the context of the financial statement as a whole. So that is an initial filter. If something is material, then it needs to be considered, and if it is immaterial, both individually or in combination, then it does not. However, it is important to remind ourselves that materiality can cover both qualitative as well as quantitative, and this may affect the both disclosure part, measurement part, and the quantity part. To understand how an entity is affected by climate change, an understanding of two different areas is required. One, what the requirement of IFRS accounting standards are, and the entity's business and risk and opportunities. An example, do the effect of climate change means that the estimated useful life and residual value of certain assets change? Do changes in customer preference means that new products and services need to be developed? or existing ones changed? To what extent can production facility be repurposed? For example, car manufacturer that produce internal combustion engine may be able to modify them to be capable of producing electric cars. In the context of jurisdictions that have banned the sale of new internal combustion engine cars from 2030 or 2035, it will be important to understand the overall business strategy in the short, medium and long term. When considering the accounting impact of climate-related risk, it is also important to consider the disclosure requirement and the effect of these climate-related matters. These we will discuss mainly about information that is relevant to an understanding of the financial statements, materiality, sources of estimation uncertainty, and significant judgment, and the foregoing concern. Let us take up these matters one by one. Presentation of financial statement, disclosure of relevant financial information for understanding the financial statement. See, under IS 1 there is an overarching requirement for information that is relevant to user and necessary for understanding the financial statement must be disclosed. Are the disclosure required by other IFRS is sufficient to provide an understanding to the user? Entities in sector affected by climate change may need to disclose information about climate related matters even where the financial statements are not directly or materially impacted. Now let us understand what are those information, what is the initial filter. The initial filter is definitely the materiality, but how material judgment should be made for climate related matters. A materiality could be by size or by nature or by both. Also the qualitative external factors, example industry or investor expectation, may make some risk material and may warrant disclosure in financial statements regardless of their quantitative impact. For example, if investor expect that climate related risk could affect carrying values of asset, disclosing why there was no impairment may be material. Example, why assumptions are not affected. Presentation of financial statements, estimates and judgment. We need to provide the sources of estimation uncertainty. Climate related assumptions may be significant and would therefore be in scope of requirement of IS 1. Disclosures may include nature of assumptions, sensitivities or range reasonable possible outcome in relation to the method used, assumptions and estimates. Some of the example of climate related estimation uncertainty: commodity price assumption used in impairment model, oil and gas, useful life, cost, discount rate, timing assumption for decommissioning of provisions. Example of climate related judgments: identification of impairment indicators. Now let us understand the going concern. The climate related matters could also impact the going concern. Going concern could become a significant issue as the impact of climate related changes is understood, quantified. Disclosure of uncertainties and judgment: climate changes may have an effect on long term viability of the entities. Now let us discuss some of the IFRS standard which may result the impact relating to climate matters. Climate related matters may cause a company's inventories to become obsolete, their selling prices to decline. As a result, as an auditor, we need to check the net realizable value are based on the most reliable available information. Climate related matters could impact the income tax, especially the deferred tax. Deferred tax is recognized if resulting from deductible temporary difference and in unused tax losses and credits to the extent it is possible that future taxable profit will be available against with those amount which can be utilized. Climate related matters may affect a company's estimate of future taxable profit and may result in the company being unable to recognize deferred tax asset, or if already being recognized, it may result in its impairment. Now let us see the impact of climate related matters on PP and intangible assets. Climate related matters usually give rise to transitional and physical risk. These risks are resulting from changes to customer sentiment, New laws and regulation, increase in cost to operation and maintenance. Physical risk, impact of acute conditions like flooding, wildfire, etc. Longer term effect of changes to weather at a regional or international level. All these risks, these which we discussed, transitional risk and physical risk, may affect the useful economic life, impairment, residual value, additional capex on replacement of assets. We can see that the area in PPE which could be affected are useful economic life, residual value, value in use, and capitalization of those costs. Usually the drivers of the change are those resulting from business models and activities, changes in the way assets are realized, changes in the cash flow estimates, laws and regulation could also impose additional restriction on the use of some of the assets. We see that climate related risk like transitional risk and physical risk may result in indication of impairment, cash flow changes, discount rates, DCF modeling. DCF means discounted cash flow modeling may also change. Impairment of non-financial assets. Indicators of impairment, significant could be also be affected. Significant adverse changes in environment is an indicator of impairment which could trigger an impairment review. Not always readily apparent, could be longer term in nature and more judgmental, may arise from internal changes, example net zero commitment and other climate strategies. Significant judgment which may also require disclosures. Impairment of non-financial assets could result into the review of cash flows, forecast period, multiple probability weighted cash models, discount rates. It could also impact the determination of the terminal value or growth rate. Climate related matters could also impact the financial instruments. How is it classified and measured? There is a focus on sustainable and ethical investing. This could depend on ESG type. Example, the interest rate of a loan may increase by 50 basis point if emission targets are not met. And the credit risk also may be affected through physical or transitional risk. Example, loans made to sectors that are sensitive to such risk, such as oil and gas, mining industries, mostly related to the coal. Financial statement could also focus on sustainable and ethical investing, borrowers, financial liability. Climate related features may give rise to an embedded derivative, resulting in the requirement of separating those derivative from the instrument as a whole, and those derivative needs to be measured at and classified under fair value. It could also impact the lender financial asset. Cash flow could fall under SPPI, resulting in classification of a financial asset at fair value through profit and loss. So from the lender perspective, those classification may change because it may not meet the requirement of solely payment of principal and interest. Hence, it may not meet the amortized cost model, and then it needs to be classified under fair value through profit and loss. That's all. We can discuss more about it, but I think the ISB educational material is sufficient for that. I fully recommend you to go through those ISB educational material for those climate changes related matters. Thank you so much.